Good morning, everyone, and welcome to Saturn's webinar today. My name is Joyce, a financial advisor at Saturn Advice. Thank you for taking the time and being here today. I hope you do enjoy today's session. Now, we're already halfway through 2021. Time flies, and the share market, the global market, has delivered reasonable return despite the fear of Delta variant, high inflation, and bouts of market volatility. The question invariably come up is where to from here. Today, we are delighted to have Shahrukh Abdali joining us, offering his views and outlook for the various asset classes. Most of the audience would have known Shahrukh already. By way of introduction, Shahrukh is a financial advisor at Saturn Advice. He is also a CFA charter holder, which is one of the highest distinction one can get when it comes to investment management profession. Shahrukh has vast experience in investment banking, corporate finance, and portfolio management. Welcome, Shahrukh.
Thanks, Joyce.
Before I hand it over to Shahrukh, just want to go over some basic housekeeping stuff. So today's presentation is information only, not to be taken as personalized financial advice. We will be recording. If you wish to play back and listen to the key points, please use the link which will be emailed in the coming days. We do have a live Q&A session today. Throughout the webinar, if you have any question, don't be shy, just pop them in there by using the question box, which is located at the left-hand side of your screen in the auditorium. We will have about 15 minutes towards the end to deal with your questions. Now, without further ado, I will hand it over to Shahrukh. Shahrukh, I'm just going to hand over the control to you. Bear with me.
Well, I think I do have the control. That's okay.
Oh, it's with you now.
Okay, thank you. Well, welcome everyone. Thanks a lot for joining this webinar. As Joyce has been kind enough to give an introduction for me, I'm going to skip that part. So what I'm going to talk about today is I'll give you an outlook for the investment world and where we stand today. What are the risks and opportunities for an investor looking out to the future? Before I get into that, must take you through the fine print. So anything you hear today is not personalized advice. It's for information only. I cannot give personalized financial advice without knowing your individual goals and objectives and circumstances. So if you are wanting to get personalized financial advice, do get in touch. I'm more than happy to help you out. Plus, I have taken all the necessary steps to ensure the validity and accuracy of today's information. But at the end of the day, I'm still relying on our third-party sources for the information. I can't really provide a guarantee to the accuracy of that information. Lastly, anything you act upon by hearing any information or any opinions today can have no liability on me or anyone associated with Saturn Advice, simply because, as I said, I'm not providing personalized financial advice. In order to take investment decisions, you need to take into account the individual circumstances and what you're trying to achieve. So do not go ahead and act on the basis of any information that you get from me today. Do get in touch, and I'll be more than happy to provide the personalized advice. So who we are, so Saturn is a group of companies. You can see in the slide, there's Saturn Advice, which is the advice business, which is where I sit. Saturn Advice is specializing in investment planning, retirement planning, and we also have discretionary investment management service, which is actually a really efficient way of managing a portfolio. And it works really well for any investor who's not wanting to be hands-on with what goes in and out of their investment portfolio. So the investment committee at Saturn, tweaks and analyzes the strategies on a quarterly basis and takes decisions based on that analysis. So the portfolios are kept in line with our best investment ideas quarterly, which is pretty good. Saturn Invest is the other business, which is a superannuation scheme. Primarily, it is qualified to accept pensions transfer over from the UK, but essentially, we can broaden the horizon and we can accept superannuation schemes. We can accept any super investments from any other superannuation schemes pretty much anywhere. National Capital is the third one, which is a digital advice business for KiwiSaver. That is a part of the business which does take commission. I'll come to the commission bit in a bit. But National Capital is a pretty good tool for anyone looking to get KiwiSaver advice, because typically there aren't too many advisors out there giving advice on KiwiSaver. So it's a pretty good tool to take a look at, so you can find more information on our website for it. The business Saturn Advice was founded about 30 years ago, more than 30 years ago. The prime motto for us is to help people take the right financial decisions, and by doing so, we help them to create a richer life for them. As I said, the commissions, we are not a commissions business. So Saturn Advice has got nothing to do with commissions. We do not take any commissions from any third parties, not the brokers, not the funds that we would recommend, or we get any remuneration for any of the products that we put in front of our clients. All the staff at Saturn Advice are paid a fixed salary that practically takes out any conflict whatsoever in giving advice. So me as an advisor, I am doing this webinar, but I'm doing this because I want to provide information and help people take, get good financial advice. But I don't really have an incentive to get new clients because I don't have a sales target to achieve at the end of the day. So when I'm sitting in front of a new client, my whole motive, and that goes for all Saturn Advice advisors, is to provide the right financial advice, not to get a better paycheck in their back pocket. I've told you about the services we provide. We have offices in Auckland and Christchurch. Across the two offices, we've got 8 advisors, 4 in each of the locations. Our typical clients include individuals, families, trust, estates, and companies. It's a very vastly experienced team that we have. Do reach out to us. So in terms of what we are doing today, I will be talking about risks and opportunities across asset classes. And the main asset classes that are available for investors are international shares, Australasian shares, which is primarily Australia and New Zealand, international infrastructure, property. I should point out here that the investment in property is listed commercial property, not residential housing, international fixed interest, and lastly, I'll talk about New Zealand fixed interest. So within international fixed interest, what you can see here is in that bar chart, I've put in various indices. S&P 500 is US, Nikkei is Japan, we've got Europe in there, UK, and I've also got the emerging market index in there. The middle bar is quite interesting because it represents the 12-month return up to June, and you can see some really healthy performances there. Most of these regions have performed north of 20-25% over the 12-month period, but obviously that has been partly because of the recovery we've had from the COVID sell-off that happened February, March last year. Now, a key question that I was quite extensively asked through last year, but even now some of the more conservative clients ask me, is that, well, pandemic is still very much there, but the share markets are well above the peak that they hit before the COVID sell-off happened. How did the financial markets recover so fast, and on what basis, when the world is still struggling with the effects of the pandemic? And when's the recession coming? So the answer to that is we actually had a recession. It was a very sharp recession, to be honest, one of the worst contractions across many of the major economies. In the US, for example, the economy witnessed the highest calendar year contraction going back to the World War. So that's 74 years. The UK had the worst recession ever in history. So we did have a recession, but the impact on the financial markets was very short-lived. It was very deep. The financial markets did fall from the peak to the bottom by about 35 to 40%, but the bounce back was really, really strong. So what really caused the bounce back, and why did the financial markets bounce back so quickly? And the answer to that is, first, markets are forward-looking, so they do not necessarily reflect what is happening today, but what is expected to happen going forward. Something to be really mindful of when you're looking to choose investments. The share price could be reflecting expectations of the market about that company's future rather than where the company stands today. So what happened when the sell-off was at the peak of the pandemic? When the pandemic broke, the sell-off really happened intensely. The turnaround was supported by the policy support from government and central banks. Quantitative easing is a term which some of you might have heard or would be familiar with, because it was very much in the headlines going back to the global financial crisis back in 2008, 2009. But there was a key difference. So when quantitative easing was implemented back in the global financial crisis, the approach was top-down, when the governments and the central banks bailed out big financial institutions. Big banks were bailed out, insurance companies were provided money to survive. And the whole idea was that that money would then trickle down to the consumer. But this whole process took fairly long. And in the meantime, there was quite a bit of pain for consumers as well as companies and businesses. And as a result, the recession from the global financial crisis lasted almost around 2 years. This time around, the approach of quantitative easing was different. It was executed from the bottom up. So many governments around the globe paid out paychecks to the consumer on top of the unemployment benefits that you get in some of the countries around the globe. They were given paychecks. So consumer actually, while they were stuck at home because of the economic shutdown, people lost their jobs, businesses shut, nobody could do anything. They were still getting money. They were still getting paid, so they could pay off the bills. But what also happened at the same time, they couldn't really go about their normal lives. They couldn't go to the restaurants because restaurants were shut. They couldn't travel to, for vacations and holidays because borders were shut, and there was the pandemic. That resulted in surplus cash with the consumer. So what we saw was personal debt and credit card debt went down, and savings rate went up. So standing today, I'll give you an example. The US, for example, in the US, the household savings is currently close to $4 trillion. That's a lot of cash that's just sitting there, to get mobilized. And people are now beginning to come out of their social restrictions over the last year, because vaccinations are progressing. They're lagging a bit in New Zealand. I'll come to that in a bit. But in the US, for example, in UK, quite a few places in Europe, vaccinations are progressing quite well. So there is quite a bit of optimism that the world will open up again over the next few months. And with all this money sitting in the sideline, it can be expected that the consumer will come out and start spending, because we are social beings. We would want to go back to the activities that we are used to doing. So there is a fair bit of spending capacity on the consumer side. Now, what happened on the supply side? So businesses, obviously, they would have debt on their balance sheet, as well as they'll have some assets, some equity, and then the corporate bond buying program was implemented as part of the quantitative easing from the central banks. what that, in layman terms, what that did was essentially the central bank would go to the company and say, we'll buy off the debt and we'll give you cash for it. So that really strengthened the balance sheet for the companies. Now, obviously, we are still slowly getting out of the pandemic. So the demand is picking up from the consumer side, but it's not really at the level, anywhere close to the level it was pre-pandemic. But what businesses have is the capacity to actually expand. They have the cash that they can spend into, investing into new projects, hiring new resources, and get the supply ramped up. An unintentional consequence that has happened through this quantitative easing, the bottom-up approach, which is sort of throwing things a little bit off balance, is there have been a decline in participation rate in the workforce. So people who were close to retirement obviously were forced to sit at home, and they got paid while they sat at home. And now, when they have an opportunity to actually go back to work, the question that's going around is, do I really want to go back to work after all of this? And the pandemic is still, it's not over. COVID is still out there. Sure, you might have been vaccinated, but you still face the risk of catching the variant. There are variants of COVID that are going around. So what was seen is there have been quite a few early retirements. So the collective workforce is much reduced. There is going to be a ramp up in workforce as time passes. But in the meantime, if demand comes on and supply takes a bit of a lag in coming up, there is an disequilibrium for the time being, and that can create inflation. So that's probably the main concern going around right now, that is the economy going to heat up faster than expected, and is inflation going to come back faster than expected, and what that is going to do, how will the interest rates change, which sectors will benefit, which sectors will get hurt. Now, I've talked about regional opening. So some of the places are well ahead in terms of reopening their economies. US, quite a few states have now removed the restrictions of having face masks out in the public. And then UK is still on track to open up on the 19th of July, unless they delay it even further, because the Delta variant is spreading. It is causing new cases, but particularly it is limited to those parts of the world or regions which are low or behind in vaccination. So if you've been vaccinated, it is found that the Delta variant also does not cause any extraordinary jump in hospitalizations or deaths. So yes, you will fall sick, but the symptoms will be manageable. The vaccine rollout, I've talked about, variants is happening. Now, as the economy broadens, the economic recovery broadens, that is our base case scenario. While there are risks, the variants and the delays in vaccine rollouts, the base case is that the world is going to continue to progress beyond COVID, to a world beyond COVID. And the reason for that is the bite of COVID-related headlines is much more diminished to what it was 15 months ago or even 12 months ago. Previously, the headlines about COVID was front and center for everyone. And now, people are more used to negative headlines related to COVID. So the fear factor of COVID continues to diminish. And as it continues to diminish, the world will start to come back to normal. It is not going away. Don't misinterpret me saying that COVID is not going to be there in future. COVID is going to be most likely to be part of our lives going forward, but it is not going to have as much of an economic impact or social impact as it has had over the since the beginning of last year. So as the global economy broadens, the outlook for certain sectors is going to be different to others. The lockdown favorites, the technology sector, obviously really benefited while the world was in shutdown. And US being pretty technology heavy has benefited quite a bit as a result of that. on a relative basis, that means that the cyclical sectors or the economic cycle sensitive sectors are going to benefit as the economy broadens. And think of automobiles, for example, or financials or energy to an extent. Although you get into the ESG sustainability, it becomes a bit of a complex answer. But largely, those cyclical sectors are going to benefit quite a bit because they have lagged while the world was in shutdown. So Europe and UK, for example, are pretty heavy, and Japan, for that matter, in automobiles as well as financial sector. So those regions are well placed over the next 12 months or 18 months to benefit relative to the US because the economic recovery is going to broaden out. But that said, at the end of the day, it all comes down to the earnings. So, while the tech sector has had a really, really strong run and the valuations have really gone up, I would like to add that most of these big technology companies are actually really high cash generating businesses, and they've got piles of cash which they can deploy to acquire other businesses, other technologies, and evolve into much more diversified, bigger companies. So at the end of the day, it will be in earnings that will capture investors' minds and the market participants. And if there is a miss in earnings, the company share price will take a hit. If the earnings come up as per expected, that's a good thing. And if they come out with a better than expected earnings announcement, then yeah, it will go up. So that's essentially where we at in international shares. In Australasian shares, have to say, Australia is going through some troubles on the COVID front with the Delta variant, and I think I read somewhere there's a new variant, Lambda variant, which has been found. So there are variants which are breaking out in the community, but that risk is also very much present for New Zealand, which largely we are back to our normal lives. Yes, certain sectors are still hurting because the borders are shut, but we can go to the restaurants, we can catch up with friends over coffees, we can go about our normal lives. But the risk to community is still very much there from COVID and its variants, because largely our population is still vulnerable. We haven't had widespread vaccinations, and we haven't had a bout of COVID in the community, which would have given us some immunity. So the risk is very much there that at any moment there could be a COVID outbreak within the community. Now, what is that doing? It is suppressing the confidence level on the consumer side as well as on the business side. So businesses are still a bit hesitant to really invest into their expansion. And on the consumer side, we have witnessed a fair bit of return in consumer spending. But again, those sectors which are still suffering, think of tourism, for example, and by that account, hospitality, even the education sector is a big contributor to the GDP in New Zealand, and foreign students aren't coming. So those are the sectors which are holding back on the spending front. So the GDP pie as a whole is smaller, and it is going to be a bit of a drag until the borders are relaxed. The government and central policy support has been quite similar as overseas. Both Australian and New Zealand governments have been pretty aggressive in providing monetary support. We've got the wage subsidy similarly Australians have had that. There has been the bond purchase program as well. So it was very much in line with what was happening overseas, and that has provided sort of a bridge from where the pandemic was happening initially and the economic shutdowns were happening to the point where the world will start to come back to normal. So none of the policy support has been taken away, although there are now talks that the quantitative easing might be tapered over the next 12 months or the next 2 years. So there has to be a return to some sort of normal, but as yet the support is very much there. I've talked about the border control. The tourism, hospitality, and education industries are really suffering, and they are going to continue to suffer until the borders are open. Nobody knows when that's going to happen. Hopefully, once the vaccinations are done, we won't have any border control, or we'll have more relaxed borders. The extension of the bubble seemed to help. With Australia, there was some tourism that started to and fro. And this is quite important because China is really progressing well in their vaccine rollout. They're vaccinating more than 15 million people a day, and they are expected to reach that 70% herd immunity level by September, October this year. And if New Zealand at the same time also gets vaccines, it's sort of like a fingers crossed kind of thing, because while the government announced their vaccination rollout plan back in March, it was very much dependent on the delivery of those vaccines, which were contracted. But there's been delay because there's been vaccination nationalism. Everyone wants the vaccine first for themselves before passing it on to the next country. And also, from the world's point of view, New Zealand isn't really suffering because, again, as I said, there isn't any community transmission here. So we are enjoying our normal lives while there are other places in the world which are really suffering. So there isn't really any urgency to provide us the vaccine, and we don't really have a political clout to really pull ourselves up on the priority list. But having said that, on the flip side is we are a really small population. We don't really need big amounts of vaccines to vaccinate the entire population. So hopefully, we do get supply and we are able to execute the vaccination of the wider population within the next few months. And if that happens, I'd say that will be the trigger point for the government to relax the borders and things to open up. There has been, I've talked about vaccine, the sectoral outlook is very much dependent on consumer spending. And I've said that tourism, hospitality, and education sectors are going to continue to hurt until the borders are open. But in the meantime, consumer spending has to be maintained at a sustained level in order for the economy to fully come back. So that is where we at with New Zealand and Australia. It's been a better journey than quite a few other places over the past 18 months. But where we stand today, it is very much dependent on vaccinating the wider population, where Australia as well as New Zealand are lacking some of the bigger countries overseas. Now, infrastructure is interesting because, quite interestingly, infrastructure was looked upon as a defensive shares asset class. But what we saw during the pandemic sell-off, infrastructure hurt and it struggled to come back up. Reason being, infrastructure is there are airports, there are toll roads, bridges, there's infrastructure in energy, utilities. Each of these subsectors within infrastructure have different traits. So airports, for example, while there has been a return of domestic air travel, international long-haul air travel is still very minimal. And until that returns, aeronautical revenues will be suppressed and airports will continue to feel the pain. But it is improving. And as I said, if vaccinations do keep progressing and the world keeps on track with the widespread reopening, then that is going to come back and the revenue stream will start to pick up again. Now, another interesting factor that happened as a result of pandemic was people have started preferring driving over public transport, simply to avoid being stuck in the crowds in closed spaces. And that has resulted in increased traffic on toll roads and bridges. So it is beginning to pick up the revenue stream from these infrastructure assets, but it is still well below where it was pre-pandemic. So there's still further upside to this asset class. Energy infrastructure is also picking up because oil demand is picking up as a result of the economic recovery, and the oil price has also gone up to reflect that. But that's also swayed by supply and demand factors. OPEC Plus, for example, is in a deadlock in terms of the supply they're going to provide. So those factors can have an impact on oil price and in effect have an impact on the energy infrastructure revenues. Utilities infrastructure was probably the only subsector which just sailed through the pandemic period because people were still paying for their power bills, they were still paying for water bills. So utilities infrastructure practically had no repercussions or minimal repercussions through the pandemic. Going ahead, infrastructure spending has been agreed to by many governments all over the globe in a bid to increase job creation. As I said, workforce pool has reduced. So what you want to do is you want to engage more and more people. So job creation is quite foremost. The unemployment levels have come down, but they are still much higher, from a historic point of view. This whole process of infrastructure spending is going to create renovated infrastructure assets, and renovated infrastructure assets do have the potential for providing greater revenue streams. And then new infrastructure assets are also going to be developed, which again can be a source of more revenue stream for investors. So fund managers in the international infrastructure space are keenly looking at those factors and are on the lookout for these good infrastructure assets which can add to the revenue stream and thereby provide a good return. Now, property, as I said, what I'm talking about today is listed commercial property, not residential housing. There is an impact of interest rates. It is very much related to the movement of interest rates, and the relationship is actually inverse. So if interest rates go down, the valuation for property goes up. And the reason for that is actually twofold. When interest rates go down, the mortgage rates go down, but more so because the future cash flows in terms of leases and rentals is now more valuable because the discount rate, which is used to bring those future cash flows in today's value terms, is dependent on the interest rates. So if interest rates go down, the discount rate goes down, and the denominator that is used to discount the future cash flows is smaller. So the value of those future cash flows goes up. So there's an inverse relationship with interest rates when it comes to property and with most asset prices that would broadly hold. Within the property sector, the subsectors have, experienced different traits or different that they've behaved differently as a result of pandemic. The hospitality sector is suffering from border control and will continue to do so until the borders are relaxed. The retail sector, now this is interesting because e-commerce is not new. E-commerce has been there, for years, for decades, to be honest. And the transition from retail, the brick and mortar stores to e-commerce has been happening over these past few years. But during the pandemic, everyone was shut at home. They couldn't really go out, visit the malls. The malls were shut. So a lot more people got introduced to e-commerce. I have been buying, stuff online for ages, but my dad, for example, has never really done any online shopping until he was stuck at home. But he realized that, you go on the website, you do a few clicks, and it shows up at the doorstep. The whole system works. So that the level of trust has really increased in e-commerce, and we've seen a transition towards e-commerce, which wasn't really expected to happen until, say, another 5 years. So it's been really accelerated. Going forward, any business without an online presence is really going to struggle because this transition is going to keep happening. It is continue to lean towards e-commerce. Obviously, there will be those retail stores or retail outlets which provide an experience, and there will always be those consumers which will still want to, go and get a touch and feel of what you're looking to buy before you actually buy. Within office is also an interesting, dynamic that happened. Work from home existed pre-pandemic, but during the pandemic, it was very widespread. And the masses realize that, oh, actually, this flexibility is great. I don't have to be stuck in the commute to the office and back, and I can work outside of business hours if I'm working from home. So take my example, during the lockdown, I could, in the middle of the day, go do some grocery shopping to avoid, the long queues, or I could spend some time in my veggie garden, and then work through the evening to get the job done. But I didn't really feel like I was at work because I had this flexibility. I was at home. And it turns out I'm not alone. A lot of people actually enjoyed that flexibility and the improved work-life balance. So what happens from the investment point of view, there is going to be lesser demand as a whole for office space. Now, how does that affect listed property businesses? New office businesses in good locations with good facilities will still have demand, but at the detriment of, or at the disadvantage of, older office space, which is where businesses will move from. So as a whole, I think the office space sector is going to suffer structurally going forward. Industrial is one sector which has really benefited from the pandemic. By industrial, I mean warehouses or logistics assets, and supply chain disruptions has really amplified the impact as well. So there has been a lot of demand for warehousing, also because of the advent of e-commerce. Warehouse space has been quite sought after. So industrial assets have seen a lot of demand, from investors, and accordingly, the share prices of companies operating in that subsector have gone up. So that's again something that fund managers are keeping a close eye on. International fixed interest. Historically, the interest rates have been really low. Well, not historically low at the present time. And the relationship, again, is the same as is with property. When interest rates go down, the valuations go up. And that can be seen, over this period. The interest rates have gone down over the past 3 years, more so since COVID happened, and that has pushed up the price. But why is this 1 year practically zero? Reason for that is earlier this year, around about February, March, there was, the vaccine rollout was beginning to gain some steam. It is now full on. But the optimism around reopening really accelerated earlier this year. And that led to fear of heated economy and inflation. And when inflation happens, central banks can control it by raising interest rates. And when interest rate is expected to go up, that pushes down the expected valuation for fixed income assets. So that is what has caused the fixed income valuations to go down. Now, the last quarter has been okay, but it's not really a big return. It's about 1%. But there's been a bit of a tug of war between the market participants who think that inflation is going to be structural, which means it is going to be there. It's not going to be transitory. And then that other side which says that it's going to be transitory, which actually includes most of the central banks. Central banks tend to agree on the messaging that inflation is transitory and it's going to blow over. And as a result of that, quantitative easing is still very much there. But as I said earlier on, talks of tapering is beginning to happen, which means that at some stage within the next 12 to 24 months, we will start to see some pullback or normalization from the policy front. The big picture still very much revolves on COVID. If there are any more new variants which are resilient to the vaccines or more contagious, and they cause a further delay in the reopening, then that can have a further impact. It will create more uncertainty, and when there is uncertainty, investors tend to prefer defensive assets like fixed interest. So that can sort of boost up the returns if uncertainty accelerates from where we stand today. If the economic recovery does continue on, then people will still look towards higher growth assets, and that's not going to help returns from fixed interest. Inflation, I've talked about. If inflation does accelerate higher than expected, or it stays at levels which are higher than expected, then interest rates will start to go up. And again, that's negative for fixed interest valuations. New Zealand fixed interest has had a pretty interesting run. The last 1 year return has been negative, and that is very much dependent on the expectations that interest rates are going to start to go up. RBNZ today is expected, already might have made an announcement, I haven't kept a tab, but today RBNZ is expected to announce that they will start to raise the OCR later this year, or at the latest early next year. So that expectation that interest rates are going to start going up within the next sort of 12-month period, that is hurting the performance of fixed interest in New Zealand. So you can see negative returns for the 1 year. It's not really big negative. It's just about over 2%, and quarterly is marginally positive. But the whole idea about having fixed interest in a portfolio is to have a lower volatility asset. Typically, performance of fixed interest does not move too much up or down over time compared to shares. So they can act as a bit of a handbrake in a portfolio which has growth assets. Economic recovery is very much dependent on the border control relaxation. The economic recovery, the numbers that have come out, the GDP numbers that have come out recently have been better than expected. And that is primarily because housing, particularly residential housing sector, has gone up. There's been quite a bit of house price inflation over the past few months, and that has helped with the GDP growth. There is still pent-up demand, and there is supply chain disruptions, which can create inflation, and hence, there is the expectation that interest rates are potentially going to go up. But again, RBNZ has cited that over and over again, that until they are comfortable that there isn't really any excess capacity in the economy, they are not going to raise interest rates or pull back the policy support. But there's an interesting graph on the bottom right here, 6-month term deposit rate. It goes back all the way to 1965. So 6 decades, you can see the interest rates currently are at historically low levels for term deposit holders, and they're not even pointing up. They're still very much low. And remember, term deposits are a cost to the bank. They are not going to be in a hurry to raise term deposit rates, while they would be in a hurry to raise mortgage rates, as they've already started to raise mortgage rates. Some food for thought for anyone listening who's got term deposits. So what does this all mean, and how do we bring it all together? The idea is to have your investment not in any single asset class or single sector, but in everything. You spread yourself across to achieve the diversification. So what I've shown here is a table with baskets representing different types of assets. So term deposits, properties there. You can have direct shares and bonds. There's managed funds, and then private businesses is also an option. But you need to have your money spread across all these asset classes, and not just in one region across asset classes, but across the globe, across different regions. The easiest way, well, you can do it on your own by picking shares and bonds all over the globe across different asset classes. But it will take a lot of time. It will require a lot of skills, a lot of research, and you'll also need a lot of money to get the appropriate exposure across all these different asset classes. The easiest way to go about achieving this diversification is through managed funds, and that to a managed fund portfolio. So you can invest in one managed fund which spreads the assets across different asset classes. But if you've got a managed fund portfolio, you can have better diversification because you'll be using dedicated fund managers specifically looking at each asset class that that is in their mandate. Another chart that I've got in there to highlight the importance of diversification. So say if you invested in umbrellas or just sunscreen, you would still experience this seasonality based on what the season is. But if you invested in umbrellas and sunscreen, irrespective of the season, your earnings will be much steadier. Obviously, they won't be in a straight line as it's been depicted in this graph, but you get the picture. This graph shows the actual return for some of the asset classes that I've talked about over the last 3 decades, since going back to 1993. Incidentally, the best performing asset class is actually New Zealand shares at 7.7%. That's the black line at the top. US shares are closely behind, followed by Australian, world shares, New Zealand property. Now, while I've talked about listed commercial property earlier, New Zealand property here is reflecting residential property. So this is based on QV data, and 4.9% per annum has been the return or the increase in house prices over the last 28, 29 years. This might seem too low given what we've seen over the past few years, but mind you, that's exactly true. The past few years have been quite extraordinary. You can see this gray graph. It's been hugging this line, which is actually term deposit, and it's only started to pick up around about 2013, and it's broken away from there, and it's been quite a bit of acceleration. So actually, most of this acceleration in house prices has happened over the past 7-8 years. Prior to that, house prices were not really that active. There was a bit of a boost up in early 2000s, but then the GFC happened and things flattened out for the next 7-8 years. So that's the actual return from house price increments. Now, the big factor that really goes in favor of residential property investing is leverage. That 4.9% return magnifies if you're not using all your money. So say if you invested 50% of your money and then took a mortgage of 50%, suddenly that 4.9% return becomes 9.8%, and 9.8% is a pretty decent return. But if you don't have a mortgage, or you're looking to extract an income, the total return argument really does not hold for residential property investing. And then I've also got inflation just for completion in there. I'm going to just skim through this graph, but this is the US share market going back 100 years, just to give you an idea of how an investing in share markets works. I've been asked many times, well, people can lose a lot of money through investing in share market. Remember the 87 crash. Some of you who have been around for around that time would remember, the chaos and the pain that happened as a result of the 87 crash. That 87 crash is reflected there, that sharp 30% drop. It was pretty short. But what followed was a really big run-up. And then we had the tech bubble, the dot-com crash. Then there was a little bit of recovery and outperformance. Then we had the global financial crisis. Took some time to recover out of it, and then we had this fantastic run over the last 10 or 11 years until the COVID sell-off happened. It says there, about 19.6%, but that's over, on a quarterly basis. It's from the peak to the bottom. It was a much sharper decline than that. But what you can see is we've already recovered, and some beyond that. So what I want you to take away from this graph is share markets will have their up and down movements. There will be downturns. There will be, recessions and corrections. But at the end of the day, they always bounce back. And as the previous graph showed, over time, you get a pretty decent return if you stay on track and if you are investing in the proper diversified manner and not holding, just a bunch of stocks which you've heard over, from the neighbor or the barbecue. Lastly, this is the performance of Saturn's strategies up until June 2021. You can obviously see, the 1-year returns are really, really high, particularly at the growth side. So the strategies go from conservative all the way to very aggressive. And I've also got term deposits in there for comparison. The 1 year returns, for example, for the very aggressive is 26%. But that's not a usual return. That captures a fair bit of the recovery from the COVID sell-off. Middle of the pack is also pretty decent at 14% or 16% for slightly balanced growth. But what I would recommend you to focus on is the 5-year performance. 5-year performance is, again, compared to term deposits, it's way better. And something in the middle, which is where most of the clients would land up. Balance growth is done nearly 11%, balance is done nearly 10%, and that's after deducting the fund manager fees, obviously before tax and before Saturn fees are taken off. But if you would like to find more information on Saturn fees, please do get in touch. We are very transparent about our fee structure, and nothing is hidden for our clients. I'm going to skip through these because these slides actually just talk about what you should consider in planning for your retirement. Actually, I'll stop here. And Joyce, are there any questions that we can attend to? If there are none, then I'll talk about these slides.
No, so far we haven't actually had any question coming through.
That means I'm doing a good job explaining things. Now, how would you go about planning for your retirement? Think about what you want to achieve. Where do you want to retire? When do you want to retire? Would you go on reduced working hours, or would you just flip the switch and just completely retire? What would you like to do when you retire? So think about what makes you happy or what gives you satisfaction if you didn't have to work for money. And those are the activities that you would be doing in your retirement. And then you have to figure out how much money would you need in order to have the retirement lifestyle. So in order to, for example, go on holidays, upgrade cars, dine out, whether you want to, dine out at 5-star, award-holding restaurants, or you just go down to the fish and chips, those kind of decisions really have to be taken into account for when you're deciding on how much income would you need in order to survive or enjoy your retirement. Once you've determined that, the key question is, well, how much money do you need to accumulate in order to generate that retirement income? So that is the next piece of calculation, that you need to come up with the lump sum that you should have at the point where you are looking to draw a retirement income. And then the next calculation would be, well, how do you accumulate that lump sum? So for someone who's younger, among the listeners, you could have, a fair few years to retirement. The key question would be, how much should you be setting aside, and how you should be investing that money in order to efficiently accumulate enough money for your retirement. And for those who are close to retirement or who are already retired, the key question is, how much can you actually spend and not worry about running out of money, in your lifetime? I mean, nobody can really predict what the lifetime is going to be, but a rule of thumb is good, is to have sufficient cash inflows up to the mid 80s, which is when, from experience, clients typically tend to slow down in their retirement activities, their leisure activities, holidays, going about their social activities. So there should be enough money to sustain the retirement up until the mid 80s. That's probably a good rule of thumb in your calculations. And then obviously you develop a plan and then implement that plan. KiwiSaver should be part of that, particularly for the younger ones. Regular and lump sum investing and having the right investment strategy is pretty key. So you could be putting money in the bank and you could be doing that for a long time, but there won't be, practically whatever you put in is what you will have in the bank, because there isn't really much return from term deposits. So it is very important to have the right investment strategy, particularly if you're young, but also if you are, close to retirement. I've heard this from, there's a prevalent concept in the market, in the advisory world, that if you are retired, you're conservative. You have to be conservative in your investment strategy. And my question is, even if you are retired, well, if you're, say, late 60s, you've still got 15 or 20 years ahead of you, in your retirement. Well, that's a really long time frame. So if you're conservative, you're not really choosing the right investment strategy for you. So it's really important to have the right investment strategy, to be successful in retirement planning. How can a financial advisor help you? Well, identification and setting of goals. That's what we would do to start with. Then developing the roadmap in order to achieve the goals, and then helping you. Well, there are obviously some budgeting and KiwiSaver tips that we can provide, but the key value add from an advisory point of view is choosing the right investment strategy and then helping the client stick to that strategy. A very common mistake that investors make is, emotionally decide on their investments. I've seen that happen over and over, but most recently with the COVID sell-off, when the market started to fall off, people were asking me, well, should we be going into a conservative strategy because the markets are now falling? But they didn't start doing that, when the markets initially fell. That only happened when the markets had been falling for a month. Well, there's no point in now going into conservative because you've already taken the hit in terms of the markets going down, and all you'd be doing is crystallizing those losses up until you sell out of growth assets. Any decline in share price is unrealized or on paper. You're still holding the same amount of units, same amount of shares. And unless those companies are structurally damaged as a result of the economic impact, they're going to bounce back over time, and you'll have an opportunity to bounce back. So those kind of behavioral mistakes is what financial advisors can help investors avoid. And I can guarantee you they can make a very significant impact over the longer term. Yeah, so that's pretty much it from my side. You can see some details if you wanted to get in touch. There's the email for me personally, or you can reach out to the business. There's the website. There's some really good investment insight articles available on the website. Have a read of it. There's the contact number for my personal number as well as the business number. Either way, get in touch if you've got any questions, or if you think that we would be able to help you with your financial decisions and help you live a richer life.
That's fantastic, Shahrukh. Thanks for the valuable insight. And you certainly sums up our job as a financial advisor really well. We help people stay connected to their goals and show them a pathway to get there. Now, thanks to everyone who listened in. I hope you got as much out of that as I did. We will be sending a recording along with some feedback forms to help us deliver relevant contents in the future. And this kind of market outlook is something that we will do more often. So we will be running this on a 6-monthly basis. So watch out for the next market outlook webinar invitation. I know that's a lot of information to unpack today. As you digest and watch the playback of the video, if you have any question, Shahrukh's detail is in front of you. So do get in touch. We look forward to helping out along the way. Thanks, everyone. Bye.
Thank you.